Hey everybody, Levi here. A little bit different of a video coming at you today, and I'm going to use a lot of the knowledge I've gotten from my clients that I've talked to over the years and talk a little bit about small business structure here in Canada, and most importantly, talk about the difference between sole proprietorship and a corporation, or rather incorporating your business in Canada, and just go over a really quick comparison and sort of highlight the pros and cons of each and kind of share some insight as to when you may want to make that jump to incorporating. Obviously, I'm not an accountant or a lawyer, so definitely run any of this past the professionals you use. But I find there's a huge lack of good information on this stuff, so I thought this would be a really great video for any of you guys who do have a sole prop and are thinking about incorporating. And again, just kind of share some of the insights I've learned over the years. Kicking off, we'll talk about sole proprietorship and sort of some of the benefits of that. I actually just made a video on how you can create a sole proprietorship, and as you saw, it's about a 5-minute video, and that's the first key point. Is there's a really easy setup. There's super minimal paperwork, specifically no paperwork, and very low startup costs. It costs between $20 to $50 to register your name and create a sole proprietorship. In that, you'll get your GST number and everything, so it's super inexpensive. On an ongoing basis, the kind of the tax consideration is just your business income for the business you register is just reported on your personal tax return. There are potential for tax deductions for your legitimate business expenses. So if you have a cell phone, you use your vehicle, any marketing, things like that, you are able to write all that off by registering a sole proprietorship. And then, yeah, basically all the income that you get from your business just goes onto your regular personal tax return. So if you have a job, you'll have your T4 income and then any business income on top of that. Or if you are doing your business full time, you will just have to declare all of that income as income. So if you make $100,000 a year in your plumbing business, net profit, then you as a person just make 100K and you have to pay tax on that. It's very straightforward. And the only basically tax advantage is you can deduct basic business expenses. The next thing is liability, and that is, and with a sole proprietorship, you don't have any a way to dodge liability, so to speak. You are personally liable for any business debt, lawsuits, things like that. There's basically no corporate veil between you and your business activities, so that is definitely a con for sole proprietorship. Management, this sole owner makes all the decisions. There's just you. There's no directors, no partners, nothing like that. If you want to do something, you do it. If you want to make a bank account, you just go make it. There's no one else involved. Generally, a sole proprietor is going to be most suitable for small businesses with low risk and simple operations. A really typical example would be if you start up a lawn mowing business or a simple online business, reselling things, t-shirts, whatever that may be. It's a great way to get started and not invest a bunch of money into legal stuff and just kind of get going. And like you saw in the last video, you can do all that in about 5 minutes. Corporations, on the other hand, are quite a bit different. The first thing is there's a much more complicated setup. There's a lot of paperwork and much higher startup costs. Creating these starts at minimum $500, but it's pretty common to spend a couple $1,000s. I've heard people spending more. I think they're probably getting ripped off, but generally you are kind of looking in that $1,000 to $2,000 range. The taxes, there's a lot more considerations that go into this. A corporation will be a separate tax entity. It's going to have its own CRA number, so it's literally viewed as its own thing. And there are a lot of very significant potential tax advantages. Most notably, there are abilities to income split if multiple, family members work in the business. You can pay income to them. You can get some split income. That has changed a lot in recent years, but there is some room there. And then another really big one, and this is probably the biggest tax implication of it, is the ability to do tax deferral. So say you have a business that's quite profitable. Say you make $300,000 a year, but you personally only need maybe $100,000 to live off. Instead of taking all $300,000 and paying a very high personal income tax on that, which would be at the highest rate, 54% or so, depending on your province, you can leave all that money you don't need in your corporation and pay tax at the SBD rate, which depending on your province is approximately 11%. So basically, instead of having to pay 54% on most of that, you pay 11% on most of it. And then that allows you to leave it in your business that you can either reinvest, buy more equipment, invest in growth, marketing, all that stuff, or just make general investments, equities, savings accounts, real estate, things like that. So in a way, it's basically like a unlimited room RSP that you can do all sorts of stuff with. Basically, a lot of the benefits of an RSP you'd have by that investment in corporation. There are a lot of other tax implications on that because you do have to pay, interest tax and whatnot. So again, talk to your accountant about that. But in short, if you are making a lot more money than you spend, you're probably going to save a lot. Another big advantage is liability. The owners do have very limited liability, and there basically is a layer of protection between you as a person and the business. So if something goes wrong on a job, your clients can't just personally come after your house and all that stuff. There is a layer there. You can talk to your lawyer, but that's a big consideration and a big benefit for people who have incorporated businesses. Another big difference is management structure. With a corporation, you're going to have a board of director who makes decisions. Now, the board of director might just be you and your spouse, and the spouse might just be secretary, but they will have voting shares. And if you even something small like making a bank account, they are going to have to sign off on stuff. So again, there's just more kind of like potential complications, but more protection as well. Corporations are going to be most suitable for high-risk business, so businesses with a very large chance of a lawsuit, higher income owners who save a lot of money, also businesses seeking investment. If you are raising money like VC money, you'll obviously need a corporation so people can get shares and all that stuff. And then lastly, those planning for significant growth and succession. A corporation makes it a lot easier to pass things down to your kids or other people, or to eventually sell it. And kind of on that, another big example is the lifetime capital gain exclusion, where each Canadian has about a $900,000 exemption on the share of Canadian-controlled private corporations, which are corporation shares. So let's say you start up a plumbing business and it's making a few $100,000 a year, and then another person wants to buy it for, let's say, $1 million. You would basically pay no capital gains tax on that if you were selling them the shares of a corporation. But if it's a sole proprietorship, you would be. So again, another big advantage. So anyways, that's kind of the pros and cons. Again, the biggest considerations each of you are going to make are your personal liability protection and how much you need that. If you have a high-risk business or you're prone to lawsuits, you're going to probably want to lean towards a corporation. Another one, tax advantages. Corporations allow some income splitting, dividend tax credits, and more complex tax planning strategies. So if those are things you're at that level where that's going to benefit you, that's going to tilt the scales. Raising capitals, if you're attracting investors and venture capital, again, you know which one's going to be right for you. Business succession planning, easier to transfer ownership and estate planning if you have a corporation, and benefits, offering pension plans and other benefits are a lot easier within a corporation. So again, those are kind of some of the reasons that would make you want to lean towards one or the other. Hope you found that insightful. Anyways, definitely consult with a tax professional and a lawyer to determine what is best for you. But hopefully this gives you a good inclination on why you might want to pick one or the other. If you found this kind of information useful, be sure to like, comment, and subscribe. I typically make videos on marketing stuff, but occasionally branch out on other topics that I find interesting. So if you did learn from this, be sure to let me know. Otherwise, we'll see you in the next one.